Hello, my dear hardworking students. We're ready for our final discussion of bonds. Yeah, but the last presentation was a little scary with all those calculations, right? Well, they're not that hard. Do them a few times and you will find that, oh yeah, I can pull this off. Just make sure you do the calculations inside the parentheses first. And today we're going to finish up with talking about the yield spreads amongst bonds, the yield curve, a very interesting potential indicator of future recessions, and a calculation that should look vaguely familiar when we come to bond valuations. So let's get started on slide number 20, the yield spread. Remember the spread from the ask and the bid price? Right, the spread is just a silly word for difference. The yield spreads are the differences in interest rates that exist amongst various sectors of the bond market. In general, the shorter the maturity, the lower the rate. The longer the maturity, the higher the rate. And this just makes common sense, as we'll see when we get into more detailed discussion in a couple of slides. Also, the higher the rating, the lower the interest rate. Of course, right? If you have a very good credit score, you're going to pay fewer interest dollars. You'll have a less interest rate than somebody who has a much lower rating. And then the pecking order is such that treasuries carry the lowest rates. Munis are next, and within munis, general obligation bonds typically have lower credit risk than revenue bonds, because if the entity that's creating the revenue bellies up, doesn't produce that revenue, then you got problems. But the general obligation means, yes, the city, the state, the county, whatever it is, they have to come up with that cash. And then, of course, corporations are much less stable than government entities, so they have the highest rates. And non-callable are much more desirable than callable, so they're going to give you a lesser interest rate. So it's a pecking order, isn't it? And so here we are on slide 21, looking at the yield spreads for both treasuries and corporate bonds. And if you're looking at this on a your cell phone or so, you can't see those numbers, but just go to this website. Now, as I've said, Yahoo is in the midst of destroying their financial website and doing a very good job of it. So you can no longer find this link on their website. You have to use it directly from the presentation, or it's also on my on the class website. But it's sad because it was a really good resource, and I literally I sent an email to them. I actually sent it to Verizon because they're buying Yahoo, and I said, please bring back the old, this is so terrible. And they escalated it to one of their most important things, and the lady just came back and said, well, we are willing to listen and to any of your suggestions except that one. Well, that's the one, if you go to the discussion boards, that everybody's crying, please bring back the old one, please bring. They won't do it. They're disgusting. I don't know what I wish them a lot of success. I don't want anybody to go out of business, but except for Microsoft. But this one would be not bad either, considering how they just don't care one way or the other if it's useful or not. So let's take a look. Sorry, I digress. My apologies. But you see, 3-month 0.25, 6-month 0.45, 2-year 0.82, 0.97, 1.3, 1.8, until finally the 30 years 2.5. So indeed, the longer the money is out there, the more interest people are going to expect in general. Right. And then when you go to the corporate world, you find that the yields are higher. So 2-year in the U.S. Treasury was 0.82, and 2-year for, let's say, just or both AA and A in the corporate world were 1.04. It's not a big difference. It's not a big spread. We're a very tight spread now. Look at the 10-year. 10-year for Treasury bonds, 1.8. 10-year for, let's say, A-rated, 2.57. It's fairly tight spread, it's called. And then if you go to the 20-year A, you're only getting about almost 4%. Boy, it's really low. Interest rates are extremely low. So let's continue on slide 22 by discussing what we just discussed in quickly, is in that investors will speak about the bond spreads as being tight or wide. A tight spread means the interest rates among the bonds they are evaluating are very close to one another. And so the example, I should actually change this example, shouldn't I? A treasury paying 4.8%, ha 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 ha, when you have to go back 10 years. Well, I don't even know. You have to go back a long time to see that. And then corporate bonds paying 5.1%. Well, that's what we saw on the previous slide. We saw, for example, the 10-year was 1.8 and then 2.04, right? It was very close. A wide spread means there's a big difference between the bond interest rates. And so if a treasury is paying, say, 3.2, corporate bond was paying 8.2, that was a huge spread. And as we said, bond yields have been very tight. Now, during the turmoil, they widened significantly. Why? Because everybody flew to, it's called flight to safety. They ran to the safety of treasury bonds, and they dumped their corporate bonds and their muni bonds, as we saw in the in chapter 9 when you took a look at the muni bond quotes, the Ford quotes. And now they've narrowed significantly. They have narrowed significantly to the point where not only are they very, very low, they're also very tight. Slide 23. Here is the effect of inflation on bond rates. Well, this is, not your best graph, but what it's showing you is the 10-year, that's the blue, 10-year treasury bond, and inflation. Now you notice the red graph is much more volatile because inflation has a tendency to jerk up and down over the years, and of course in the late 70s and the late 80s it started to get out of hand, and that's when the Federal Reserve Bank jacked up short-term interest rates, which jacked up long-term interest rates, which caused a severe recession in 1982, but broke the back of inflation, and we see inflation dropping significantly in the early 80s, and bond yields, bond rates coming down and down and down. And then look at inflation in 2008 and 9. In the Great Rate, it hit negative. And people were not happy. They don't like inflation, but boy, do they hate deflation when their wages are falling and their Social Security checks don't get any increase every year. Yeah, right. So be careful what you wish for. And now here we are, where with inflation about 2% or so. This is actually a couple years old, and the 10-year actually below 2% now. So you see, inflation jacks up the interest rates and eventually causes the inflation to abate. Hopefully, please, sometimes. Yes, usually, yes, indeed. Slide 24, the yield curve. This is a graph that represents the relationship between a bond's maturity and its yield at a given point in time. And so we use this, as we do the spreads, to make comparisons amongst types of bonds. Normally, during normal times, which is mostly all the time, the bond yield curve is upward sloping. That means that longer-term bonds have higher interest rates than shorter-term bonds, which is typical, and it makes sense, right? If you're going to leave the money out there for 30 years, you want more interest than if you're going to leave the money out there for 2 years. But sometimes the yield curve is inverted. It is downward sloping. That doesn't make any sense. You're right, it doesn't. And it's very rare, and it is often a precursor to harsher times ahead, as we shall see. So let's take a look on slide 25 and look at the two situations. Here is more typical, the red curve, the upward sloping curve with shorter term bonds having less interest, less reward than longer term bonds. Now, the upward sloping curve, the downward sloping curve, the alternative, the blue, is first of all very pronounced. I mean, this is you haven't seen this since the 1980s, but this high. But still, sometimes short-term rates are higher than long-term rates. That doesn't make any sense. Well, slide 26. Let's take a look at what it is now. This is from Morningstar, because Yahoo used to have the best graph, and now it's gone. So, as I said, they're destroying their website the best they can. And so, Morningstar's this is actually a little. It should be more sloped the other way. It's kind of the inflection's a little on the lower side, but still, this is the yield curve. This is what's going on. 3-month are paying very, very little, very low, and 6-month, and then 2 years, and then 5 years, until you get up to 30-year. These are the treasuries. They're paying, less than 3%. Not not that great for the. I think they're paying a little bit more than 3%, but not much more than 3%. I got to go back to that one slide, but still. The yields are very low, but it's still upward sloping, right? It's still lower interest rates for shorter term maturities, higher interest rates for longer term maturities. So, slide 27, we finally address the issue here. Why do longer term debt securities normally have higher interest rates than shorter term debt securities? Well, it just makes sense, folks. It just makes sense. The longer the money is out there, the more chances for things to go wrong. And so we have 3 different hypotheses. Expectations hypotheses. The shape of the yield curve reflects investors' expectations of future interest rates. Well, that's true, because investors are always thinking about the future. The maturity preference hypotheses, or in terms of liquidity, investors prefer the liquidity of short-term securities. They know they're going to get their money back, and therefore require a premium to invest in longer-term securities. They may or may not get their money back. And then lastly, the market segmentation hypothesis. The market for debt is segmented on the basis of maturity. So there's a supply and demand market within 3-month, within 2-year, within 10-year, within 20 years. And each of these makes sense. Each has merit. I mean, it's just common sense. You don't need a PhD and come up with these beautiful theories and hypotheses. But how do we account for the times when the yield curve is inverted? What factors could cause a inverted yield curve to occur, and what does that tell us about the future of the economy? Well, dear students, slide 29. Since World War II, every time the yield curve has inverted, short-term rates were higher than long-term rates, the economy has fallen into a recession. There was one exception in 1966 when the economy just went down to 0% growth. It didn't go negative. Then it picked up again. So every time, almost every time, whenever there's an inverted yield curve, we've had a recession. Now, the last time was 2006 and 7 and 9. 2006, 2007, and 2008. Before the 2008 turmoil, the yield curve was slightly inverted. It wasn't very inverted, but it was slightly inverted. And that's the bond market telling us who's more important, the bond market than the stock market, right? And the bond market's telling us a recession is coming, but it didn't seem that the stock market really cared. The stock market was saying, well, where is it? You've been telling us so for 2 years, right? Well, it wasn't until the fall of 2008, when people saw the wheels starting to fall off of the economy, that the officials charged with tracking the economy acknowledged that we were in a recession. All their indicators were saying, no, we're not in a recession yet. It was one of those, Peter Lynch calls them Wile E. Coyote moments. The Roadrunner and the Coyote, where the coyote runs off the cliff and is suspended in midair, and until he looks down. There was that. I wasn't one of them. I was thinking, it's not going to be that bad. We're going to take a hit. This housing bubble's going to hurt us. There's no doubt about it. But it's not going to be that bad. And Value Line, I'm reading Value Line, and the Value Line saying, well, we think we're going to muddle through. We think it's contained, is what Bernanke said. And then we looked down. Right. It took over 2 years, but the bond ghouls were finally proven right. Now, why are they called bond ghouls? Well, think about it, dear students. When interest rates go down, what happens to bond prices? Right, bond prices go up. When do interest rates go down? Usually in a recession. So, I don't think that bondholders in general are hoping for a recession, because most bondholders also own stocks, but that's the term they're given because they love it when interest rates go down. Interest rates usually go down when there's a lot of turmoil and a recession. So there you go. So that's the yield curve. Is the yield curve invert? No. Is the yield curve going to invert soon? Well, the Federal Reserve Bank is responsible for short-term interest rates, and they have said they're going to slowly raise the short-term interest rates over the next, how many years? I don't know. Probably before I'm dead, but who knows? And when that happens, if the economy does not respond or has not responded, then we would expect long-term rates to not rise, in which case we would have an inverted yield curve, and the Federal Reserve would have made a big mistake. So we'll see. Let's hope. You hope that the economy is going to get stronger. It's been getting. We had a heart attack. We had a very serious, situation in 2008 and 2009 where it could have been a whole lot worse, folks. It could have been a whole lot worse, and we're slowly digging ourselves out of it. Slide 30. Bond pricing. Okay, now for something completely different, as Monty Python would say. Let's take a look at the valuation of bonds. Bonds are normally priced according to the present value of their future cash flows. Boy, doesn't that sound familiar, right? Slide 30. Present value, future cash flows. The discounted cash flow model. Yeah. We get our semi-annual interest payments. Now, what big difference? You get paid every 6 months versus getting paid once a year, whatever. And then at the end of the term, 10 years, 20, 30 years, we get our principal back. Although other factors always need to be considered, such as the creditworthiness of the issuer, because if an issuer runs into trouble, what's going to happen to the price of their bonds? Right, that's what credit ratings are for. Because credit ratings are there to help you stay away from bonds that are going to potentially be in default, in which case the price will plummet. Slide 31. The bond price is equal to the present value of the interest income, the future cash flow from the interest, and the present value of the principal repayment, the future cash flow from the principal coming back to you, the principal repayment. It's the discounted cash flow model. Now, we really should do semi-annual compounding because bonds pay every 6 months. But hey, annual compounding is much easier to compute and will give you almost the exact same answer. Plus, we have a spreadsheet that does it for us. So we're going to learn the manual way using annual compounding. You then can go take a look at the spreadsheet, and there's a little presentation about the spreadsheet that does the semi-annually, and it's like $2. You know, the difference is over 10, 20 years is a few bucks, so big deal. Slide 32. Here's an example that I chose specifically because the yield was very close to an integer, 3%, very close to integer. And that's because our table only has 3, 4, 5, 6%. Of course, if it's 3.7%, then that's a little harder. But hey, that's why we got this the bond calculation, the bond calculator, the spreadsheet. So here's some here's a bond from Goldman Sachs, Government Sachs as it's often called, the investment banking firm that's paying 5%. 5%, which is, as we said, high by today's standards, isn't it? It's due in 2024, so that's another integer. It's due in 8 years in November, so that's why I chose that. Price to yield almost 3%. So we got the yield to maturity. Oh, typo, it should be 3.011%. And the current yield. The current yield 4.387. How we do that? We take the $50 we're getting and we divide it by the current price. The price that we find in the marketplace. And the reason we chose this bond is because it's close to 8 years in maturity, very close to 8 years maturity, and very close to 3%. Now, what are you going to do? You're going to get the present value table for Chapter 10, which should look very familiar, right? Very familiar. Because it has, instead of just one table, it has 2 tables. Now we could use the table from Chapter 6. If you print this out, you will see that the table from Chapter 6 is on the right side. But we've introduced a new table. And why is that? Because instead of looking 3, 4 years into the future, we're looking 8, 10, 20 years into the future. And if we just used the table from Chapter 6, we'd have to do 20 calculations or 10 calculations. That's why we have the new table. The new table does a calculation for several years, providing we get paid the same amount every year. Well, that's what bonds do. They pay us the same amount every year. So how are we going to do this? You take the $50, because remember it's a 5% bond. The $50, actually we're getting $25 every 6 months, but just forget that for now. We're getting $50 every year. And so what is the present value of that $50 per year for the next 8 years? Well, the present value factor, the present value multiplier on the left table for a stream of income tells us we should multiply that by 7.02. So what's $50 times 7.02? Your calculator will tell you it's worth $350. I'm sorry, $352.20. So that means if we require a return of 3%, we're going to get $50 a year for the next 8 years. Today, the present value of that $50 times 8 is $352.20. You see, the future cash flow is $400, right? $50 times 8. But we have to bring it back to the present. And at 3%, it's worth $352.20. Does that make sense? Now, if you don't believe me, go through and do $50 every year at 3%, right? Multiply that on the old Chapter 6 table, and go year 1, and then year 2, and year 3, and year 4, 5, 6, 7, 8, and you'll see that it should come out very close to $352.20, maybe $352.40 or something. Then, because the table only uses 3 digits of accuracy, so there's going to be a few pennies off. We're not trying to be perfect because we're just calculating valuations, and we know that especially for stocks, valuations are very off the mark. For bonds, we're going to find that they're a whole lot closer. Then that's the present value of the interest income. Now, remember, at the end of the 8 years, we're going to get our $1,000 back. Well, what's that worth to us today? Now we use the Chapter 6 table. That's the table on the right. We go across the 3% down 8 years, and we find 0.789 is the present value factor for a single payment, because we want to get the $1,000 once. We don't get it every year. And that's worth to us today $789. Check it out. Do your calculator. Come on, you can do it. Go print out the table, because you're going to need it for the worksheets. And you see 352.20, the present value of the income, plus 789, the present value of the repayment of the bond, is equal to $1,141.20. And the price quoted on November 1st was $1,142. So we're, a dollar off, right? The bond calculator gives us something very, very close for annual payments. But for semi-annual payments, wow, it's almost bang on the dot, 42 cents away from the actual price of the bond. Pretty close, right? Why is the semi-annual payment prediction a little bit higher? Well, because we're getting the money a little bit sooner. We're getting $25 after 6 months and then $25 after a year, instead of waiting the whole year for the $50. So it turns out that, yes, dear students, bonds indeed are very boring. Bonds are fixed. We know how much we're going to get, so we can easily discount. That's the word we use. We can easily discount. We can easily bring that value back into the present and find that, assuming there is no general belief that the company or the municipality is going to go bankrupt, in which case all bets are off. We're not going to get our future cash flows. The prices for bonds are fairly reliable. Yeah, bonds are fixed. Bonds are boring. Now, what's the wild card? Interest rates. Do we know what's going to happen to interest rates in the future? No. So if we have intention of selling our bonds in the future, especially if they're long-term bonds, we may or may not get what we think we're going to get. And there are people, dear students, who are paid tremendous sums of money to incorrectly predict where the future interest rates are going to go. Indeed, you could be one of them. You get a fancy title next to your name, and you tell people why interest rates are going up or down, and then when you're wrong, you tell them why you were wrong and why you're going to be right the next time. And you too can get paid big bucks on Wall. It's kind of like technical analysis. Yeah. Slide number 33, reinvestment risk. Now what is this? Now this is where we have to think long term in our bonds. In my humble opinion, it's always a good idea to think long term when you are an investor, right? The reinvestment risk is the uncertainty about the future value of an investor's bond investments that results from the need to reinvest bond interest payments and redemptions at yields not known in advance. Well, now wait, just think about it. You're going to be getting your income from your bonds in the form of interest, and you're going to be getting the bond redemptions, right? The principal repayment. Do you know what the interest rates are going to be in the future when you take that cash and reinvest it? No. Now, some people don't reinvest them. They bought the bonds for income, and they're using that income to live off of, and so they don't care, right? But if you're a long-term investor, especially if you have a huge bond portfolio, which means you're also a very high net worth investor, you have to reinvest that money. And so this is why, let's read. This is why changing interest rates don't only affect the price of your bonds. They also affect your future income as you need to reinvest the interest income and the bond repayments. If interest rates have fallen, yay, yippee, my bond price is going up, but your income level will fall as you reinvest your income in bond repayments. Oh yeah, my 7% bond just matured. Now I'm getting 3%. Likewise, if interest rates have risen, your income level will rise. And this is why I try to get people who have a long-term perspective investing in bonds to stop worrying so much about interest rates going up. You're right. You're absolutely right. Your bond prices are going to fall. If you have a bond mutual fund, it's going to be affected. There's no way to get around that. Interest rates are going to affect the short-term value of your bonds and your bond mutual fund if you're investing in a mutual fund. But think about it. Those bonds are always bringing in new interest payments and new principal repayments, and now you get to reinvest that amount with higher income bonds. So if you extend your time horizon, rising interest rates for bondholders are not necessarily a bad thing. Now, if you panic, right, and I think it's going to happen too. I really do think a lot of investors who fled stocks for the safety of bonds and have been very happy because interest rates just keep continuing to fall and fall and fall, and in some countries are negative, which means you're paying people to hold your money. When interest rates start to go up because the economy globally is doing better, we haven't blown ourselves up, or Ebola hasn't become the rage, or disco hasn't returned. When the economy globally picks up a lot of steam, interest rates are going to start rising. They have to, right? The demand for money. Forget the central bankers and the short-term interest rates. I'm talking about longer-term interest rates. And I think a lot of bond investors, specifically with bond mutual funds, they're going to see the value of their bond mutual fund fall. And they're going to panic. They're going to sell at the wrong time. And they're not going to realize that this is a good thing. It's a good thing. Stocks should do very well. And bonds over the long term, as they reinvest that income into higher paying bonds, will do well. Yeah. Yeah, right. How do you get people to think long term? It's not easy, right? They're thinking, what's going on in the news tonight? Slide 34. Now we're going to discuss in the next few slides a few topics that for most investors, you and me, and for many others in the workaday world, is not that important, really, because we just don't have that huge a bond portfolio. The duration of a bond. The duration of a bond is a measure of the bond price's sensitivity to changes in interest rates and bond yields. It captures both the price and excuse me, my apologies. The price and the reinvestment risk. It is used to indicate how a bond will react in different interest rate environments. The duration of a bond changes as it approaches its maturity date, hence the term duration, and the current interest rates change. In general, the longer a bond's maturity, the longer its duration, and the higher the bond's nominal rate and yield to maturity, the shorter its duration. Yeah, the shorter the duration, the less price volatility. Potential. Again, if you, vice versa, the longer the duration, the more potential price volatility. Again, if you hold your bonds until maturity, you don't care. And immunization. What a great name, right? Slide 35. Immunization. Well, investors who have a specified time horizon can use bond immunization to increase the probability of successfully achieving their desired goal. You keep the average duration of your bond investments equal to your time horizon. So you know, this money is needed in 7 years, or this money is needed in 12 years, or 3 years. You thus would be more protected against interest rate induced price swings. Well, the problem with this is that it requires constant rebalancing of your bond portfolio, since durations of bonds change as interest rates change and the bonds get closer to maturity. how many people have a huge bond portfolio? Not too many. So who's interested in this stuff? Pension fund managers, mutual fund managers, bond fund managers. Right. If you have bought an intermediate term bond fund, which means, 3, 4, 5 years, the bond fund managers are going to have to worry about this. You don't have to worry about this. You're just looking at your bond fund. And so unless you are a high net worth individual, meaning you have hundreds of millions to invest in bonds, because remember, they don't even want to talk to you unless you got $25,000 to invest, the minimum. And it's not important. So remember that it exists, and it's more for people, pension fund managers, mutual fund managers, life insurance companies who have huge bond portfolios. Slide 36, bond investment strategies. So we're about ready to clean up here, finish up with bonds. And let's take a look at the 3 different types of strategies. The income strategy is the one that people think of when they think of bonds. You buy the bonds for the income. Okay. If you're a speculator, you buy the bonds for the potential increase in value if interest rates fall. How easy is it to determine if interest rates are going to fall? It's not too easy. As we said, there are people who are paid tremendous sums of money to do it wrong. And then the total return strategy is a strategy where you invest for income, but then also keep in mind the possibility of capital gains. So which of these would be the easiest to implement? Income. Which is the hardest? Capital gains. Which is actually, it's almost impossible. But you will often see a bond fund, say the PIMCO Total Return Bond Fund, the most famous one that was run for many years by Bill Gross, but he's no longer there. In other words, exactly, the bond manager is looking for income, yes, but we're also looking for the potential for capital gains. And so sometimes that not only it means speculating on future interest rates, but it also means looking at bonds that have fallen out of favor, that are maybe less than investment grade, BB and below. Right, and if things work out for the company or the municipality, then the bond price will go up. So some total return bond funds have done very well for their investors, and some not. Slide 37, bond laddering. Laddering? Yes. Well, this is an idea of purchasing bonds with staggering maturities. You buy some bonds with short-term maturities, some with intermediate term, and some with long-term maturities. It's a way to diversify. Again, it's very popular with pension fund managers, bond mutual fund managers, because they have considerable sums of money to invest. What are the advantages and disadvantages? Well, the advantage is that you diversify. You have some that are short-term, some that are long-term, and then some that are intermediate term. If interest rates go down, the long term are going to do really, really well. But if interest rates go up, they're going to get hurt. Which means the short term and intermediate term, again, they're in the middle of the seesaw, are not going to be hurt as well. So it's a great time to ladder when you are really not that sure about what's going to happen with the future. So you have a diversified portfolio of different bonds, all maturing at different times. And when is it a not good time? Well, if you're a speculator, indeed, if you think, this is it, interest rates are going down, you would move everything into long-term rates. And if you thought, this is it, interest rates are going way up, you'd move everything into short-term. But I don't think that's a good strategy. I can't predict the future. I don't know anybody who can, so I like bond laddering. But again, how many bonds do you hold? If you're a high net worth individual, then let's take a look at an example. Here you go, slide 38. This is a typical ladder these days with, as we said, the 30-year Treasury is under 3%. Oh my goodness. So here we are in November of 2016, And if our 3-month treasury is going to give us 0.26%, yippee, whoopee. Well, at least it's more than it was 6 months ago, a year ago, when it was 0.03 or something like that. And so we would buy up and down the ladder. And if interest rates continue to go down, which is hard to believe, but they can go to zero, folks. They can go negative, as they have in some countries. I don't think that's going to happen here. But these bonds will react tremendously. They will make a lot of money. But if interest rates tick up, which I hope everybody hopes they do, right? We want the economy to do stronger. Please, look at it. Okay, sorry. And when interest rates go up, that's what I say. When interest rates go up, these guys their value is going to go down. There's no way to get around that, folks. And so there you go, folks. There's your bond investment ladder. And if you have $100 million to invest, or maybe just a few million, who knows? You could. Okay, all right. Wrong target audience. Slide number 39. We're done. We're done with bonds. Wasn't that boring? Exciting, yes. And we're done with bonds. So go back and make sure you understand the concepts of bonds, the calculations for bonds, the worksheets. Do the worksheets a few times. Remember, the calculations are not that hard. They look scary, but once you do them a few times, of course, contact me for any help, because we're ready to take a little side jaunt into preferred stocks and convertible securities. There's a tiny little bit of that in Chapter 18, so it's mostly all lecture. Use the presentations. Make sure you understand that. And then in Chapter 11, we are essentially done with the semester. No. We have a few other things to take care of. But the cool thing about Chapter 11 is that it ties everything together. It goes back to the very beginning and takes a look at the eternal struggle of risk versus return, and ties what we learned about mutual funds and stocks and bonds together. Okay? So we're getting to the home stretch, folks. Don't give up. Never give up. And thank you for your attention to bonds.